Hello, everyone. Jeff Fratarcangeli here for another call to action market update. I want to thank you all for joining us today. For those of you that have not joined in the past, Fratarcangeli Wealth Management's been in place since 1995. This year will be our 30th year in practice of wealth management, holistic planning. We don't just manage money. We do a number of things, but manage wealth and guiding counsel our clients on investments is certainly a paramount aspect of what we do daily in monitoring the markets. But a little bit about our firm behind the scenes. We do all the things that you would expect as it relates to wealth management, understanding the client's goals, near term as well as long term and everywhere in between, legacy planning. We also look at both sides of the balance sheet, whether it's a business or an individual, and what their debt and liabilities look like, what their expenses, of course, what their assets are, what their income levels are, what their expenses are relative to their lifestyle, and what their desires are as it relates to their goals. And all the things that are important, whether it be tax planning, estate planning, working with estate planning attorneys, understanding, having worked with many families in similar areas as to what the options are, whether it be planning ahead on taxes, whether you're having an event and selling your company, or just simply doing your annual tax planning and harvesting throughout the year, working with the CPAs external from our firm. Benefits has become a big factor. The cost of benefits, healthcare, property casualty, protecting our clients 360 degrees in areas they may not have thought of, making sure it's our job to understand what their headwinds are, what their objectives are, and making sure that we're cognizant of every potential deterrent to those goals and protecting them along the path. I was playing sports and a student athlete most of my adolescent career, and I wasn't very talented, but what I was a protector. I would always protect the best player on the team as their bodyguard, if you will. And I think the same applies to our firm and our culture. We're here to be your financial bodyguard in all forms. And we're comprised of over 30 professionals with over 250 years of experience. All over the country, we're representing clients, and we're very honored to be ranked 22 in the nation by Forbes and #1 in every state we're in, as well by Barron's and Forbes. And so I'm so proud of my team for really being involved in the day-to-day needs of our clients and leveraging our network in all forms. Today, we're going to talk to one of my partners that I've leaned on many times over the years, and someone I trust in the firm that we utilize quite frequently for solutions. But before I introduce him, we have the tariffs, right, that are upon us coming tomorrow, and how that's going to affect the markets as well as industries, as well as companies that are really sort of stuck in making decisions with the uncertainty that tariffs bring. The Federal Reserve, as they've been tightening up money supply over the recent years and recently reduced that, call it suction cup of liquidity out of the system, sort of reducing the amount of liquidity that they're taking out. How does this affect us? We have interest rates. We have the 10-year Treasury at 4.1% this morning, coming off of 4.7 and 4.8 earlier this year. We have the shorter term rates that are actually higher than the longer term rates. How does that affect the economy? We're really at a crossroads. And every time we're at these crossroads, we take a step back and we leverage our network and our contacts on the front lines that have been here in different forums to see what their opinion is. And today, I'm honored to bring to you Scott Colyer, Chief Investment Officer of Advisor Asset Management, also referred to as AAM. He has been in this position since 1998. He's also served as the Chief Investment Officer for over 23 years. While over 35 years in the industry, Mr. Colyer has become a highly respected and accomplished fixed income strategist, as well as an investment counselor. Scott's insight is frequently featured in leading financial media outlets such as Barron's, The Bond Buyer, Business Week, CNBC, CNN Money, Fortune Magazine, Fox Business TV, Market Watch, and many others of the like, including the Wall Street Journal. And I've always enjoyed our conversation, Scott, because you've just put it to me blunt. You don't mix words. You tell me what you think. And even if it's unpopular, you're not afraid to share your opinion. And so I thank you for joining us today. And my audience is very interested to hear what you have to say. And, I brought up the fact that we're dealing with uncertainty and tariffs. What is your overall view of today's economy and market? And where do you see us going near term?
Well, Jeff, there's no question that the U.S. economy is it's slowing a little bit. economies speed up, they slow down. We had a like time period back in 2018 where we paused a bit. As you'll remember, last year the Fed had cut interest rates by 100 basis points total. That's a 50 and 225s, and they're probably going to cut rates again this year. And that, once again, it's an economy where you're right, liquidity is not necessarily what it was in the pandemic or just after the pandemic. In fact, quite frankly, the government spending over the past administration can't be replicated. Our debt, we worry about the credit ratings of our debt because we're quite frankly we're now borrowing so that we have the ability to pay interest and the other costs of our government. So at that point, I would say that I think the plan that the administration has, which is more than just tariffs, they're trying to not only cut down the expense of government and the size of government, which really is nothing new. Actually, Bill Clinton did a tremendous job of closing bases and making government smaller, just like Ronald Reagan did. One Democrat, one Republican, but they're all burdensome if they are not efficient. And I think that's one big effort that's going on. I think that scares people, but it always scares people when we're trying to reduce the size of a company or we're trying to reduce the size of a government. And I think the second part you did talk about were tariffs, and tariffs really, Jeff, are not new. In fact, between the years of 1790 and 1914, when we got an income tax, the government relied on tariffs and duties for 100% of their receipts. So it's in our own history, we've actually relied on tariffs at one point to fund 100% of the government. Now, is that what the Trump administration is trying to do now? If you listen closely, they are going to install tariffs to generate revenue, and that revenue is going to come from other countries dealing their products into the largest economy in the world. And they want to create a cost or a friction for them doing that. And the idea is not necessarily to replace the income tax, a tax on wealth, but the idea is to make part of the government receipts to be paid for in the form of tariffs. There is an argument as to who pays it. I would just tell you, whoever buys the products pays the tariff, because generally speaking, industry will try to pass as much of those tariffs through as they possibly can. So I think the fever out there's a fever that is being pitched by those who didn't win the White House. There's a fever being pitched by people who are afraid maybe for their job, and I would just suggest that we've had 4 years of this president before, and his MO has always been to come in and act with strength and overwhelm his opponent, so to speak, with the first strike, and then back off and have a negotiation at that point in time. And I think we're just in the middle of this, Jeff. Will we get clarity tomorrow? We're going to get some. We're going to get some clarity. Is that the last comment or the last straw? No, I don't think that's going to be it. But I don't expect them to trash the economy of the United States. I do not. And by the way, we're not seeing indicators of that right now. Normally, if the worry out there is we're headed into a recession. Recession was off the table last year. Now it's back on the table. But we're not seeing any stress in the credit markets. We normally would, right? We're not seeing spreads on high yield blowing out. We're not seeing companies coming to market and not getting funded for debt issues. We're not seeing auctions of U.S. treasuries go unsold. We don't see any of that. in fact, quite frankly, what we see is, yes, we're slowing down, but we still have an incredibly strong employment market. And that's what the Fed cares most about. Whether or not we have one-time ratchets up in pricing because of a tariff that is put in, I don't believe that the Fed is going to count that as a permanent or a reoccurring item that would contribute to a higher inflation level. I think, once again, part of this is experimental. Something like this, the size of just sheer the size of what they're trying to do can be a little daunting. But it certainly seems to me that this is a very well thought out plan, and one that doesn't necessarily make our neighbors happy. But let's face it, other countries have been funding themselves off of selling goods and services into the United States economy for years. And I think part of what the Trump administration is trying to do is say, listen, we're going to have some reciprocity here. We're going to be equal. If you want to keep us out of your economy, let's take an example, maybe Japan, maybe that would be American car sales in Japan, then we're going to do the same to them. Now, after having said that, tariffs are a blunt instrument, and there can be some collateral damage. Trade can get very, very intricate, and there are codependencies that are set up, cross-border codependencies. If you look at our auto industry, they make parts and services and parts of cars down in Mexico. They assemble them, they bring them in either as cars or as parts. And then, of course, we sell them in the United States. Which part of that is subject to the tariff? That clarity will come in the coming weeks. We'll figure that out. We'll find that out. But I don't think that President Trump or any of his people are trying to bury the auto industry in the United States. I think they'll take steps to maybe surgically carve out some areas that so that everyone can at least have their voice heard and have some clarity on how these tariffs would be applied.
Yeah, excellent feedback. I'm just going to clarify a few things. Your comment about what these tariffs are doing, they're negotiating. They're negotiating with our trading partners in ways that makes them reconsider current structure, I think, is the takeaway. I'm also going to add to that the market, the stock market and markets in general that are trading on a by-second basis throughout the course of a 8 to 9 hour day are going to not do well with uncertainty, and uncertainty of not understanding what the impact is going to be of tariffs, what the tariffs are going to be, how the economy is going to react to it. My experience of 30 years has taught me that the market will generally price in worst case scenario. In other words, if the tariff's going to, I'll give you an example. A company reported earnings on the retail side. They beat top and bottom line. They guided more opportunistically to the remainder of the year, or I should say all of 25. And the stock ended up being down 10% on that day. And one would ask how? Well, that particular company on their shelves had 40% of their products coming from Mexico. And so what the market did is simply priced in the 25% tariff as if they were already there, took it out of the projected revenues as well as bottom line, and simply priced the company at the PE ratio that would reflect that. The reality of the situation, there was no clarity as to whether that tariff's coming to that degree or what that tariff will be. There's no clarity as to whether the price increase would be meant at the retailer's bottom line, or it would be passed through to the consumer. Furthermore, there was no clarity as to whether the company would pivot onto where they got 40% of their products because of the fee. But yet the market will price in worst case. And so you can do one of three things. You could sell everything and run for the hills, which I've learned the hard way will not benefit the long-term, what we'll talk about. They will take advantage of the opportunities by dollar cost averaging, or they'll simply wait it out. And so I think it's important to talk about the fact that the market does not like uncertainty. I'm also going to mention the fact that I think you brought up a very good point, Scott, and it's kept me up at night, is what's the liquidity look like in the market, something called M2 supply. Those of us that have been monitoring the markets for decades know that 2008 and 9, we remember very clearly. And we know that engine that we call the economy, if it doesn't have oil, what we refer to as liquidity, it'll seize up. And our concern and my concern and our industry's concern in that the government has been sucking out of the money that was injected over the last several issues that we faced, including COVID. And what does the money supply look like? And now add to it tariffs. What I heard you say very clearly, and you are a fixed income expert, that the markets are not seizing up. We are seeing liquidity. We are seeing bond offerings and lending and money flow to the level that we would hope in an environment where we have constant continued growth or opportunity for movement and activity, if you will. I have to press back a little bit, Scott. I'm from Detroit, born and raised, and I'm talking to many different industries across the globe, specifically in the United States. Automotive certainly not left behind in those conversations, as you can imagine. And I'm seeing a lot of folks on the front lines of automotive not really knowing which direction to go. And I'm seeing it in manufacturing and other industries as well, recreational vehicles, discretionary assets of the like, and being able to adapt or make adjustments or simply be mobile enough to adapt is creating a major headwind. What do you say to that? And if I could just add another point and be the, kind of the opposer of confidence for a moment to see what you say. The automotive industries just came out of having to re-pivot towards electric vehicles and restructure and spend billions of dollars, and then all for the fact that no one wants them, or certainly not to the degree that they were being pushed. And now they're getting hit with another storm. It's almost like we had one hurricane and now we've got a tornado. What do you see, and how do you, I think I have an opinion, but I don't want my opinion. I want your opinion. What do you think?
Jeff, tariffs, especially in the automotive world, are complicated. They're complicated because we have agreements with our neighbors to the north and neighbors to the south. And we have formed kind of interlocking manufacture and assembly all throughout North America and down into Mexico. That's a North American Free Trade Agreement that we talk about here. However, the benefits have not necessarily been enjoyed equally. And I think that that having tariffs on especially foreign cars is something that Trump feels might equal that out. I think at the end of the day, whatever you see installed and talked about will be eased in over time. The Secretary of the Treasury said that we think we will ease these in over time and after negotiation. Now, tomorrow in the Rose Garden, you're going to get America's Day of Liberation and we're tariffing everybody. But in the application of these, the last thing they want to do is put Detroit out of business. In fact, it's actually the opposite. General Motors closed yesterday trading around 4 times earnings. That is so unbelievably cheap. It's not funny. So and I think, Mark, when we're talking about markets and what they see and when they see, Jeff, your perspective when you're at the top of the hill is you can see everything. But when we get down into the valley, markets don't, they can't see much. And so they begin to make up worst case scenarios as you spoke of. I look at that as creates opportunity for those folks who, might want to dollar cost average. We certainly don't ever, we're always invested because we don't know when this ends. All Donald Trump would have to say tomorrow is, listen, we thought about this. We're going to be measured. We're going to work with each country to make sure that they understand what they have to do. What do you think that would do to Wall Street? It would it would explode. Things can change very quickly when it's one person's viewpoint that basically is carrying all the weight. And I think what we know from history is that this viewpoint will end up benefiting the United States and the industries of the assets of the United States, which are their industry and our workforce, and not being a detriment. Now, I understand, I'm the CEO of AAM, so I understand what it's like when something out there is scary and it threatens your employees, their well-being, and you freeze up, you don't make decisions, and that right now is what is happening, and we're having a pause. In fact, quite frankly, GDP, if you look at the Atlanta GDP now, which is their current forecasting measure, you're going to have a negative quarter in the first quarter of GDP. We don't think it will be negative, and there's a bit of a misnomer in their equation, because it takes the rise of gold prices into effect, and it actually adds that into the GDP calculation. Yes, gold has been going up. Gold has been going up for centuries. Gold normally is not a very good investment, but the reason gold has had a solid bid for the last 3 years, not just now, the central banks around the world are buying gold, and they've been buying gold in a huge fashion. Why? Because they look at it, they need some insulation against currencies that may or may not make it in the world, and they want some insulation against the US dollar. The world is run on the US dollar. The US dollar is the reserve currency of the world. And so, as you might guess, a lot of these central banks buying such gold might include places like Russia and China, who really would like to get away from trading in dollars. But unfortunately, there is no other currency, right? I mean, and I know crypto would like to be that, but during my lifetime, I seriously doubt that it's broad enough to do that. Let me tell you another thing is that if we were in such bad shape here, Europe should be worse. So should China. That's not what we're seeing. We're actually seeing those markets outperform the United States for the first time since the beginning of the global financial crisis back in 2008. That's a long time. So once again, if tariffs were threatening those countries, I don't think we would see their markets rising and doing well. Once again, markets are forward-looking, Jeff. They're not backward-looking. They don't just look at today. They have a way of looking forward. And the results you see every day in the market is because real capital is being invested to move prices up or being sold to move prices down. We don't look at any one day or 1 month, but we don't see any trend here other than retail, which is unfortunately scared at this point in time. You look at the AAI survey, the amount of pessimism there, the amount of bearishness in that American Association of Individual Investors, AAII, and they do a survey every month, and that is as bearish as that has ever been.
You're saying investor confidence.
Exactly. You look at the fear and greed index. It's published daily by CNN, not necessarily known as a financial juggernaut media, but at the end of the day, it's a very good index. It's extreme fear. Those tend to be times where you need to go the opposite way. In fact, history tells us that when we see these extreme levels of fear, those are the time you want to buy things. We're having a sale on assets. And instead of running away and trying to find some place to hide, we should probably be buying whatever fits into your individual investment
policy
plan. Plan, policy, whatever. And that's what we would say right now. We're at that point. This may not be the bottom, probably not too far away. If I were going to want to fall off the stairs, I'd rather fall off the first stair. Probably won't hurt myself too badly. But if I fall off the 12th stair, I probably am going to hurt myself. So when valuations are low, that's the time to pay attention, not the time to shut the door.
Yeah, just to add to the investor sentiment AAII survey that you're referring to, historically, I can tell you, sitting in this chair talking to people, getting the feel and the vibe from the public investors, anytime I get people more fearful is when I know it's time to buy. Anytime I hear the more conservative investors saying, hey, what about this tech stock? I say, oh boy, we're in for a beatdown. And I can tell you that the sentiment has definitely been reversed pretty quickly. I see that as a positive. And I think to add to your point, our job is to create plans that'll allow us to overcome the unforeseen negatives and being able to ride those negatives out like we learned in '08. If you can make it through, you'll be better off on the other end. And then relative to the money you're not going to need for, say, at least the next 3 to 5 years, make sure that money's compounding at a pace greater than the cost of living or inflation is eroding it. If you take those two approaches, you continue to maintain a level of balance and diversity, and you dollar cost average into your predetermined allocation, and you reassess it as you approach your targets, you will win the battle and the war, even though it may not feel right at times. And that's just experience and history teaching us. Now, it's always darkest before dawn, I'm told. I'm usually sleeping. So it always is toughest to do at the toughest moment. And as you pointed out, and I think Warren Buffett states multiple times over his 90-plus year life, is when everyone's running this direction, in that direction, you run this direction, and vice versa. When there's blood is when you pounce. And it's tough to do. We're learning the hard way. And confidence right now is awfully low. I'm gonna take it to your area if you don't mind, Scott. Specifically, sure. I'm gonna read a question that I put together in regards to interest rates and the effects of such. I mentioned it earlier. We have short-term rates, call it shorter-term rates at 4.3%, and yet we have the 10-year Treasury at 4.1%. So bond investors are getting paid less on their 10-year money, and they are on their 30-day money. So in other words, they're getting paid a higher interest rate on locking money up for 10 years than they are on money that's 30 days locked up, or at least in a investment that has that maturity. And with mortgage rates ranging from 6.5% range for a 30-year mortgage, this historically is high relative to the 10-year rate. What do those interest rates and observations indicate to you in the terms of both overall investors and specifically to home buyers? And do you see any relief coming to the home builders and mortgage market relative to the interest rate and inflation outlook? I know it's a big, broad question, but I know you're meant for those questions. So what says you?
I'll answer them by the piece, Jeff. So the first question surrounding the yield curve and actually in the Treasury market over the past 90 days or so, we have begun to see that curve steepen, not invert. So as we sit here and talk, the 2-year Treasury is at a 3.85, and the 10-year Treasury sits at a 4.15, and that's just as we sit here speaking. So we have a positive 10-year to 2-year curve. That is a normal curve. That is a curve that we see in times where economies are growing and where the demand for credit is normal. And financial institutions, including mortgage lenders, they borrow short and they lend long, and they make their money in the spread between 10-year, 2-year, or 30-year, obligations. Those are actually priced off the 10-year. The 10-year did go up earlier in your conversation. It did go up and touch a 4.8%. I think the way we look at it is the vulnerability will unfortunately be in the short end of this market, where we'll see short rates come down, especially as the Fed gets more and more involved. We do think the economy, as I said earlier, is slowing, but we don't think that long-term rates have a long way to drop. I think what you're going to see there is you're going to see the short rates go down even more. We may get a 10-year to a 3.80 or a 3.90. That could happen if the Fed has to step in. And I think potentially they might. I mean, if they see the unemployment rate begin to rise, they're going to step in. The fear is that we still have inflation, which is higher than normal or higher than the Fed's goal. But let's face it, the Fed set that goal arbitrarily. It's not based upon science, certainly not based upon history. The United States economy has run, on average, an inflation rate right around 3% over a long time period. Yes, we had a period back in the late 70s and 80s where it spiked up. But once again, we don't have anything close to that now. So I think those elevated rates of inflation above what the Fed target is will keep longer rates higher. And we're kind of that higher for longer. Finally, on mortgage rates, the housing market, first of all, there's demand for housing, right? We have the creation of families who are now going into multifamily housing because they can't afford to buy what little inventory is in the market. However, that is changing. In Florida, we now have the largest number of homes up for sale since 2008. Now, we're not seeing prices coming down necessarily in those markets, but there's more inventory. The problem is that at 6 3/4, it's very difficult for people to buy homes. Those people who were blessed with a 3% mortgage, they're not selling their homes. That 3% mortgage is an asset to them. So what do we have to do to get mortgage rates down? You're going to have to see the 10-year come down. And the 10-year mortgage is what has to come down. We're also seeing the same in California. We're seeing the number of houses put up for sale is rising. Now, remember that it's kind of funny because we compare something to 08 and say, oh my goodness, but remember, we have a whole bunch more houses that have been built, from then till now. So therefore, I'm not sure it's necessarily a terrible trend. But I do believe that a slowing of the economy will bring mortgage rates more in line. The thing is, Jeff, is that if you look at the spread to mortgage rates, FHA rate to the 10-year Treasury, 10-year Treasury just said is 4.15, 30-year mortgage is, call it a 6.70 today. That's a huge spread. Now that has come down from 7 1/4, but we think as we have a little bit of slowing, we'll see those mortgage rates get down to maybe the 6% area. But they really need to be in 5s. You can kind of go from a 3 to a 5, but going from 3 to 6 3/4 just probably is not gonna. That's probably not gonna work. But we will get there. We will get there. It's just a matter of time. But I think Bessent, he wants to get interest rates down. He knows if they slow the economy a little bit, they probably will get those interest rates down. I think Powell wants to cooperate, at least outwardly. The Fed is saying we will cooperate. So I do think there's a brighter day for housing, for housing and housing stocks. But there's going to take some time. It's just going to take some time.
So inventories are up relative to the two major states you talked about. I think that's common, which actually is probably a nice reversal because there just wasn't any inventory.
Yep.
You believe the 10-year Treasury is actually going to stay higher for longer? Maybe it'll pull back short term, but ultimately stay in those 4s?
Absolutely. And by the way, that's normal. I mean, interest rate markets are now normal. They're not at zero, which is abnormal.
Right.
Negative yielding debt that we had during the global financial crisis. Those things are stupid. They don't generally ever happen in a free, in a free economy. They happen for a number of years. I don't think the experiment worked out real well, but at the end of the day, the interest rates we have now are normal. Financials have been on a tear. Besides technology, financials are the number 2 performer in the markets, both through last year and year to date. So I do believe that we used to call the bankers that had the 363 motto. You pay 3% on savings, charge 6% on loans, and you're on the golf course by 3. And that's basically how bankers make money. That's exactly how they make money, and they're able to do that again. We do have that positively sloping curve. They're able to gain access to all the funds that they want. There's no liquidity pinch here, no lack of funds. People who qualify for a mortgage are going to get a mortgage. So unless that changes, now having said that, we do see a little bit of rise in auto loan delinquencies. We do see a bit of a rise in some mortgage, 30, 60, 90-day delinquencies. But once again, it's nothing that's shooting up and saying, oh my goodness, we've got a credit issue here.
So some concerns. What I heard you say as well is the fact that mortgage rates, the spreads should come down, while the 10-year and the interest rates on the long end should stay elevated, which is
Correct.
what I'm hearing you say is the spreads are going to tighten. I found it interesting. For 4 years, the spreads got wider, and now they're coming back to earth. Historically,
They
the
are.
10-year and the 30-year were a 1.5% spread. Today, we're sitting at closer to 2.5.
Yes. Which, by the way, buying mortgage-backed securities is probably not a bad idea. If you buy the shorter average life, they're outwardly government guaranteed, and I'm not sure if that makes a difference anymore. I'm kidding, of course, but you have the highest quality obligation. These are like the old Ginnie Maes, Fannie Maes, that kind of stuff. They are boring, but at the end of the day, it's a nice place to be in your fixed income portfolio.
I like it. Very good feedback on the interest rates and the liquidity in the market and the mortgage rates as well, and how this is going to move forward. I'm going to ask you two more questions. I'm going to start with the first one. You just brought it up, which is the U.S. dollar, right? The government, the fact that it's the global currency. Essentially, what is your opinion of the U.S. dollar and the path for the U.S. dollar? And is the tariff a positive or negative relative to the U.S. dollar? And is it going to be something that can serve as a countermeasure to the tariffs?
Well, Jeff, you hit on something very interesting. Countries can actually defend themselves against tariffs by manipulating the value of their currency versus the currency of the country initiating the tariffs. In this case, the United States and the US dollar. What we saw all of last year is we saw a rising US dollar, a dollar that rose against the euro. In fact, if you were going to go to Europe, last year was a great time to go. You had the dollar euro was, I think, 1.03, almost parity, That's now reversed. And now we have a dollar that is weakening. And I know we don't like to say, oh, gee, we hope the dollar weakens, and you'll never get a Treasury Secretary to say that, but it actually benefits us, especially if we are exporting. Those countries, or excuse me, those companies who are exporting, it makes American goods and services cheaper relative to a currency that is, is rising against the U.S. dollar. Secondly, I don't know if you'll recall, but back during Trump 1, when they put the tariffs in, we had a Chinese renminbi or yuan to the dollar ratio back then of 6.8 to $1, 6.8 yuan to $1. Today it's 7.25 to 7.3. Well, their currency they've weakened their currency against the dollar so that the tariffs don't bite. And so countries can actually neutralize tariff effects of their own to their own country by trying to print more yuan or to sell more yuan into the market. Remember, China's currency is a private currency. There's one version that's kept inside the country, one version that's sold outside of the country. They have two different markets, two different quotes. It's a bit of a, it's not really a market. It's the government sets the level. But I think you're going to see a lot of that. But we believe you're going to see a continuation of the dollar coming back down. Dollar was historically strong. We think that you'll see a continuation of that. That should benefit the U.S. economy and not be a detriment to the economy. There are a lot of folks out there that hate the dollar because it's it's the only thing you can transact in, and of course, Trump and tariffs and sanctions against Russia. They kicked Russia out of the SWIFT system. If you have to buy oil in dollars, oil is quoted globally in dollars, in no other currency, just in U.S. dollars. So you have to go out and buy dollars so you can buy oil. Other countries don't like that. And so there has been a move afoot forever to try to replace the dollar with something. Well, the problem is that whatever something is, it's certainly not the euro, and certainly not a currency like China has. It's just not broad enough to be used by the globe. The only currency out there that is broad enough to be used by the globe is the US dollar. Now, after having said that, there are people who will say, yes, Scott, but every fiat currency that's ever been created at some point in time that was a reserve currency has failed. The last one was the British pound, and that occurred in the Second World War. Basically, they thought Great Britain would be blown off the face of the earth, and the British pound ceased being the reserve currency. The U.S. dollar took over at that point. I don't see this ending anytime soon, quite frankly, because there's nothing else out there, including crypto, that can even come close to having the broad scale use globally and accepted by everybody. So anyway, maybe I hope that answers your question.
Yeah. So what you see is a dollar weakening, and I think with the Fed lowering interest rates, that's exactly what will happen.
Yep.
It would be beneficial to what we're trying to achieve relevant to the tariffs. China is manipulating the markets by about 5 to 10% based on their 25% plus tariffs, which isn't bridging the gap as much as we would guesstimate, and certainly not to the level they would want, but it's a factor. And the U.S. currency as the fiat is going nowhere anytime soon. Crypto is not the answer. Crypto is a solution that's going to be used for other reasons that we can't figure out yet. Those that think we're going to become billionaires because we bought crypto, I have a lot of stories to tell you that I've learned over the years, and including I want to sell you some swampland. That being said, it's there, it's not going anywhere, and it's going to be utilized for its technology. AI and blockchain is probably the better story to talk about. I grew up in the late 90s where .com, but yet it was the internet that we remember, not .com. Crypto, blockchain, similarities. That being said, I think the last question that I'll broaden is we've seen a great rotation, as we like to refer to it as, from growth. The seven, magnificent seven, as we call them, and the growth stocks in general, really outpacing the value stocks by double digits at times. That gap has tightened greatly. What do you say about the transition from growth to value? And is it permanent? Is it a flash in the pan, so to speak, short term, or is it something that we need to take heed to? And remember that the diversification approach is always the answer for long-term investing. What is your take?
So I would suggest this, that generally the favored horses of the last bull market rarely become the favored horses for the next bull market. And generally they've been bid up to valuations that, quite frankly, are well above market norms, and that's exactly what has happened. In fact, if you take the Magnificent Seven, that's seven companies that accounted for 35% of the performance of the S&P 500. Seven companies accounted for 35% of the S&P 500.
Got it.
When you have that much concentration in the performance of seven stocks, at some point in time, reversion to the mean is almost a science. It's almost a law of nature. The other 493 will come to life and begin to perform. What we've seen, and when I talked about Europe and let's even talk about Japan. I mean, God love them, but their bear market started in 1989 and it stopped finally last year. So you're talking about 35 years of a huge bear market, but Japan now is surpassed their highs of 1989. Most of their companies are low PE value companies. Most of the companies you find in Europe are low PE value companies. And the spread, as you said, Jeff, got so wide that essentially what will happen is when everybody's on one side of the boat, those who are on the other side of the boat tend to balance. Yeah, that's exactly right. That they tend to be the winners from that point forward. And I'm not saying growth is going to be completely out. That's not what we're saying here. But let's face it, growth has been ignored, value has been ignored for well over a decade. That's the longest time period in history. And these are companies that have solid earnings, growing dividends, and that's probably, I would suggest, more the traditional way of investing. So once again, we don't know whether growth is going to be back in or value. You're right. You have to be diversified. You have to have a little bit of each. but don't just take the dessert. Your mother always told you, gotta have some vegetables too. So we want to make sure that our tray is properly balanced, and you'll do well.
A balanced diet is what I hear. A balanced
Right.
diet in all forms of life.
Right.
Excellent, excellent, Scott. You always put it in terms and dig into the areas that I think you're the strongest of, history of experience and fixed income, and then kind of broadening it out and how it works across the global spectrum of investing, equities, international markets, domestic markets, are all, try to do it without liquidity, and you'll find out harshly, like '08 taught us, it doesn't work. And so it's an honor to have you as a partner. It's an honor to work with AAM. You've solved many issues for us over the decades that we've had the benefit of working with you, and you're always willing to take our call, and I appreciate that. I'm going to save a couple more quick things, but before I do, any closing remarks from you, Scott?
No, other than I appreciate you having me on. I do appreciate the partnership.
Absolutely. And, I will reiterate some points. Diversity. Make sure we have enough liquidity to make it through the unforeseen that many did not do in '08 and '09 and '10 during those very tough, harsh years that we compare to the Great Depression that we call the Great Recession. Make sure that we don't lose the experience and learning opportunities that we've had to prepare us for the future. Diversify into growth and value, diversify into liquid assets as well as long-term assets. Make sure that you're compounding at a pace greater than inflation on the longer-term assets. Look at areas that haven't worked recently, like international, like you've talked about. For the first time, we're seeing some upside there. For many reasons. Maybe it's the war ending in Ukraine and Russia that's anticipated. Maybe it's the valuation. Maybe it's both. But yet we have tariffs upon us that are affecting our domestic markets that should be affecting Europeans markets the same way, but they're not. That tells you right there that there's some context that we need to dig into deeper. And dollar cost average, continue to layer in over time without human hands automatically, and then take advantage of massive sell-offs to take advantage of the human hands taking action. We do both. I will also make mention to the fact that going back 45 years, we have seen the markets over, I would say, 80% of the time when they've been down over the last 45 years. 35 out of the last 45 years, the market has 45 times over the last, call it, 40 years, 45 years, we've seen the markets go down initially. I'm going to get this right, Scott, I promise. And yet 80% of the times the market has recovered and positive for the year. So let me repeat that in plain English. We've seen the market pull back an average of 14% over the years and then recover and actually be positive for the year 80% of the time that the market started out negatively. So don't think just because the first quarter we sit here with the markets being down in every index that it means we're going to end the year negative. That actually has been the opposite for 8 out of 10 times that's occurred. So remember that we're in it for the long term. We're going to dollar cost average. And our team is ready, willing, and able with all hands on deck to make sure we're being proactive, we're asking the tough questions, and we're leveraging our network. And we're here for our clients to make it through these uncertain times when you need us most. So I appreciate you, Scott. I appreciate my audience. I wish you all well, and we'll see you soon. Bye for now.